Hello everybody, as promised, this is part 2 of our webinar, Day Trading Without Charts. First thing we're going to look at is reversals and pullback points. Now I'm personally not a huge fan of trading reversals. I prefer to trade second entries, which for me is trying to get in on the first retracement after a reversal. So let's talk in terms of a short to long reversal and presume that the same thing happens in a long to short reversal. Now, one thing I do think that charts are quite useful for is measured moves. So if on the way down we've been pushing down 10 ticks with average 7 tick retracements, then it's very common to do exactly the same on the way back up. And it's just a kind of measure of volatility. So we could say with trend swings are 10 ticks and counter trend swings are 7 ticks. Now that will vary day to day, but then we all know volatility does vary day to day. Now what will often happen is the first push up off the low is going to exceed the with trend swing size, and that's one of the things that actually tells you it's a real reversal. But the first retracement usually honors your counter trend swing size. Now with that in mind, I still give the volume profile more weight than the swing sizes when it comes to pullbacks. Now reversals usually do have an area of high volume at the low. Now sometimes this is excessive volume because the bidders absorb the selling as we got to the low. They don't necessarily hold the market to the tick, and so you often see a poke down through the high volume area at the bottom like this. Now thicker markets like US Treasuries will very often hold to the tick, so as soon as you see that absorption it'll hold the market there simply because it's a much thicker market and that's the way they work. Thinner markets like crude oil and gold will be less inclined to hold through the tick and you will see more of a push down through the high volume. Now volume is usually going to be above average in the reversal even if it's not excessive, and that's simply for the reason that it's come down and gone back over the same area twice. Now excessive volume is a much stronger sign of a reversal than just a bit above average volume, and this is where we go back to what we talked about in the first webinar, is you can see when it's excessive because you see, like in this case, you'll see the huge step on the volume profile. If it's not visually significant, then it's not excessive. What we can see in this first image is that we have an area of high volume and that we're now at the low of the day. As before, I always favour a continuation, so at this point I wouldn't actually be looking at this as a reversal. Even though I favour continuation at this point, I still wouldn't look into be taking a short at this point. Now we could hold the high volume area low at this point, but that would effectively be entering the market short on a 2-tick pullback, and to me that's not a good entry point. If we went down another 5 or 6 ticks and then came back to this high volume, then absolutely I would be looking for a short entry. Now as we haven't pushed down much, I would also think that maybe it's possible we might be doing a range extension here and creating a high volume range. And so a better short entry in the case of a high volume range would actually be where these 20,000 contracts traded here. So even though I wouldn't call this a reversal at this point, I wouldn't be looking to go for a short, just seeing it blow through this high volume by 2 ticks. Now when we get to the second picture, we can see we have excessive volume at the low, and it's held because now we've moved up through that excessive volume. So right now the buyers that bought there feel good and the sellers don't feel so good, and that's how you'd feel yourself in this situation. There's 50,000 contracts traded below us. Now as we mentioned before, these won't all be short-term traders, but you can be sure that the short-term traders exiting or defending their trades will be the ones that dictate short-term direction, barring any news event. So at this point, my preference is for us to go a few more ticks up and then try and enter a tick above this high volume area. Now of course it may dip in to this high volume area, but it should not sell aggressively into it if your premise for a long trade is correct. You want the sellers to be feeling trapped, not aggressively trading it back down, which if a seller's feeling trapped and out of position and he's losing money, he's not going to be aggressively selling this down. So long here is a fairly well defined and small risk. To the upside, you potentially have the higher the day to hit. And to the downside, really, you shouldn't be in, you shouldn't see aggressive selling come down to here, 1, 2, 3, 4, 5 ticks. You shouldn't really be holding below this 2000, or even if it gets this 2000, the order flow should have really told you that, no, the sellers are too strong here. Obviously, in the second image up here, we're waiting for reversal around where this step is, but sometimes what will happen is as you're moving up, waiting for your pullback, it's going up in an extended move and you'll create another high volume node. And when that happens, what you have to do is consider that this actually might be the point you're going to pull back to instead of down here. And you have to consider two things then. Okay, if that's my pullback point, if that's where another bunch of traders got positioned, my potential reward to the upside is slightly less. My risk actually in this case probably is if this level breaks. So the risk again is slightly less. But you have to consider the potential risk and reward on every trade. But basically, if as you're going up, you put in high volume here and put in another high volume node at the top, you have to start thinking about that high volume node as the kind of most interesting point of recent action. Now, of course, this is just really one type of reversal. And sometimes a reversal just comes out of the blue without any excessive volume or even above average volume. It just goes down to a point. Nobody wants to sell into that and just pops back up. And in that case, you do need to sit on your hands, as this type of trading is all about waiting for an area where a lot of traders get into position because that is what you're trying to exploit. Now, head fakes is just another name for a false breakout. The market breaks out of a range but can't carry on up. Now, whenever you have a range, there's always people going to be stopped out when you break above the range. There's also breakout traders that are going to buy when you poke above the top of the range. So shorts are going to be stopped out by buying, and breakout traders are going to buy because of the breakout. So if you were looking to go short 25,000 contracts, pushing it up through the high here would be a great way to generate plenty of people that are willing to buy from you. Okay, and that is the first type of head fake we're going to look at, which is effectively a trap head fake. Now, in this scenario, we can see that the market broke above 33, and then we got higher volume at 34 and a little bit at 34.25. At this point, we've got a high volume node, but right now we don't know if this is going to develop into a high volume area, start rotating around it, or if it's a reversal. What we do know is that we have a lot of traders positioned below, and that in this move up, we only have cleared 3 ticks before we got high volume again. Now, in the second picture, we can see a lot more volume is traded there, and we have moved back through down the high volume area. So now, if we're expecting this to be a reversal, then we don't want to see it get up through this high volume area to the upside again. Now, in the final picture, we can see that whilst we did manage to trade 34, we didn't trade another contract at 34.25 again, and now we're headed back down. So at this point, if you take a short, you're looking at exiting at some point above this 34.25 area. If it pops up there, some of the shorts in from here are going to start to bail out. They're trading a reversal, remember, and reversal traders are just more inclined, in my opinion, to be more nervous about the upside because they're going against the short-term momentum. On the other hand, a head fake is really considered to be a range extension. So basically a head fake says that we're still in this range. So to the downside, you could be looking at 31.50, 31.25. Now personally, if I was short from this area, maybe a perfect short would obviously be 33.75 at the bottom, below this high volume node with a stop here and obviously a target here. But look at the POC. Okay, so if I was short, I'd be thinking, okay, we might get down, as low as this POC, might struggle to get through there. So I'd certainly be looking to scale some off in the 32.25 area. Now, the other sort of head fake is where it pops up through the top of the range, okay, but there's simply no interest in buying up there. So this is more of a true range extension. It's not a trap. It's not somebody pushing the market around. We don't have really many shorts getting stopped out. We don't have an awful lot of breakout traders entering the market. It's just apathy at the top. And obviously this is a bit harder to catch. With the trap head fake, just by the nature of the fact that somebody's absorbing those contracts and there's a lot of trading, so in the previous example 25,000 contracts, it's going to take a lot longer for that trap head fake to develop. You're going to have more time to make a decision. So you're going to go up there and you're going to wiggle around the area. It's not just going to turn in to an instant high volume node. Okay, but with this sort of head fake, when there's no interest, you might come back to this price once or twice. You might just wiggle there once or twice, but this is going to be over much more quickly. So you've got a lot less time to get in. Still, you do have a decent risk-reward trade because your reward, again, is to the opposite end of the range. It's time to look back at what we've discussed in both part 1 and part 2 of the webinar. The idea behind using the volume profile is we're trying to capitalize on areas where a lot of traders are committed. So after moving out of an area where a lot of traders are committed, we know that some traders on one side are going to have taken a loss. And those traders are less likely to take the same trade again at the same prices which they've just lost money. And if you don't believe that, just ask yourself what you do. Or just put yourself in that situation with a losing trade. Some traders are going to watch their trade go into a loss and breathe a sigh of relief when it comes back to their entry area. And those are the guys that exit their trades at break even by buying, if they were short, which helps the market to move back upwards to the area it originally broke out from. And then finally, you've got those on the winning side that are likely to be a lot more confident, a lot more happy, and actually more likely to add to the trade. And what this does, it gives us an imbalance in the terms of the amount of people that will buy and sell the area when price moves back there. The other thing is that when a short-term high volume range develops, ultra short-term traders or scalpers are going to be fading the extremes, and that helps to fuel any move outside of the range. Now obviously, if the high volume range develops over 30 seconds, that's not really giving the time for the scalpers to start scalping the outside the extremes of the range. Once it's been there 4 or 5 minutes, you can pretty much guarantee that at the extremes of the range, you're going to have scalpers getting in at those extremes and eventually getting stopped out to help kind of fuel the move outside. Now the high volume areas tend to start off as high volume nodes where just 1 or 2 prices of high volume occurs. So you're going to be looking for a hold if it continues through that high volume node, but you've got to have your eye on how it reacts to that level when it comes back. So if you do suspect that this high volume node is turning into a high volume area, then give it time to develop. There is no hurry when a high volume area develops, and it is actually better because you might start off, as the example on the 7th of January, you might start off with high volume node at 2 prices, and then it kind of spreads and it becomes 6 prices, and then you've got a much better idea of which prices are good to enter. Now in terms of reversals, just don't be so quick to take reversal trades. If you do take a reversal trade, you can wait for the area to hold first. You don't need to get in the high of the day. So if we look at the head fake, which was a trap, we can see we had time to let 25,000 contracts trade at the high. We saw the market move back down. We saw the market move back up to that area, a few more contracts trade. That's when we could have taken the short trade. So we did actually have, it wasn't just a fade at the top. It was a trap at the top, people absorbing the buying. But we had time to wait for a decision. Okay. Now in terms of confirming trades, okay, so I've got my trade location based off the volume profile. Order flow, as well as looking at correlated markets, are both excellent ways to confirm trades. Now we've got those covered in other webinars on the Jigsaw site, so I'm not going to cover those too much here. And one of the goals about using volume profile is it's going to give you a price where entering the market gives you excellent reward relative to risk. The thing is, you might not get to those prices. Okay, you might say, wow, I really want to buy that price, but just market doesn't move there, doesn't get to there. Now you also might find that the market trades down to your entry price, but you don't get a fill on a limit order you've got sitting there. So for instance, if you wanted to buy 1830, then what you want to do is, as well as having a limit order at 1830, if it's trading down there at bid 1830 and offered 3025, if the offers go down from like 1,000 to 800 to 600 to 400, then what I do personally is I just hit a market order buy into 3025 because I think that 3025 level is going to break, and I'll do that even if I have a limit order to buy 1830. So what I'll try and do is I'll have my limit order at 1830, I'm waiting for a fill, but if I can see the offer above me is starting to break, then I'll just hit into that offer. Okay, and then once I've got fill there, I'll cancel the buy at 1830. But sometimes you're just not going to get filled, and there is going to be a temptation to chase the trade and get in at poorer prices. Now the only time I would do that and feel good about it is if I see momentum going into the top of the range, which means you're going to see a lot of aggressive buying moving into the top of the range, and that would be even better if we'd hit the top of the range, not got halfway down, and then you see buyers come in and push it up. But other than that, you've just got to let some trades go by, okay? Because we are talking about getting risk reward in your favor more than having to worry about being right all the time. The moment you start giving up and taking poorer prices, the more reliant you become on being right more of the time than you're being wrong, okay? Now, in terms of the number of ticks I've talked about in this webinar, it's all based on the ES. You do need to make adjustments for thinner and thicker markets. And finally, if you do decide to look at trading this way, you've got to remember this is a skill you need to develop. Don't expect to be good at this on day one, but you should expect to see significant improvements after 3 or 4 weeks. Okay, this isn't something where you've got to spend 2 years staring at a screen 10,000 hours before you see yourself improve. It's weeks and not months that you should see some improvements. And one of the things you need to do is you do need to sit through a number of different types of day just to get a feel how days play out. Of course, the beauty of using the volume profile is it's simple and it's easy to make consistent decisions and control your risk reward. That's what it's all about. It's all about giving you good risk reward so that you don't have to have the pressure of being right 90% of the time. Now, if any of you have got any questions, you can feel free to email me on peterdavis@jigsawtrading.com. We do have a lot of free training material on the website, and you can also Skype me. My Skype ID is Jigsaw Trading. And I do appreciate those of you that took time to sit through the webinar. Thank you.